Mumbai runs on money that doesn't always exist on paper. The city processes financial flows that would make Frankfurt pause, yet half of it happens through handshakes and WhatsApp messages. This isn't chaos. It's a system that emerged from necessity and solidified through repetition. The Reserve Bank of India sits in Fort, a colonial-era building that now oversees monetary policy for the world's fifth largest economy. But monetary policy here means something different. The RBI doesn't just set interest rates, it manages a currency that trades in villages where electricity arrives 4 hours a day, and in dealing rooms where algorithms execute trades in microseconds. The same rupee, serving radically different purposes. Money in Mumbai doesn't flow downward from institutions to people. It moves sideways, upward, through channels that no economist really maps. A textile merchant in Bangladesh market extends credit to retailers who extend credit to customers who might pay back over months. This isn't inefficiency. The merchant knows something the banks don't, that trust accumulated over decades is worth more than a credit score generated by an algorithm. The Bombay Stock Exchange opened in 1875 under a banyan tree. Now it's in a tower, but the fundamental behavior hasn't changed much. Brokers still cluster, information still travels through networks of relationships, and somehow, a taxi driver in Bandra knows which stocks are moving before the morning papers print it. The NSE came later, bringing derivatives and algorithms. But even there, the machines must account for human patterns that make no mathematical sense. Wealth formation in Mumbai happens through compression. A family that owns a 2-room flat in Worli sits on an asset worth more than most Americans' retirement funds, yet they might struggle to pay for their children's education. Paper wealth trapped in concrete. The city creates millionaires who can't afford to be rich. This paradox drives behavior that seems irrational until you understand that in Mumbai, real estate isn't just wealth, it's identity, security, and legacy rolled into square feet. The informal economy here isn't separate from the formal one. They're intertwined like blood vessels. A construction company listed on the stock exchange pays contractors who pay subcontractors who pay daily wage workers in cash that never enters a bank. The money moves through the economy, buying tea, vegetables, mobile phone recharges, eventually finding its way into someone's savings account from where it might buy shares in that same construction company. The circle closes, but nobody tracks the full loop. During demonetization, when the government withdrew most currency overnight, Mumbai didn't collapse, it adapted. Suddenly, vegetable vendors had Paytm QR codes. Building societies created internal credit systems. The city ran on IOUs for weeks. This wasn't planned resilience, it was desperate innovation. But it worked. The episode revealed something important. The financial system here isn't built on currency or even credit. It's built on the assumption that somehow, eventually, accounts will balance. Private equity firms in BKC pore over spreadsheets, building models to value companies. But the real valuations happen in conversations where nothing is written down. A company might be worth one amount to a strategic buyer who understands its political connections, and another amount to a financial buyer who only sees the numbers. The gap between these valuations isn't inefficiency. It's the price of context that can't be taught in business school. The gold market in Zaveri Bazaar operates on trust so old that nobody remembers when it started. Millions in gold changes hands based on verbal agreements. The shops don't need contracts. because defaulting means exclusion from a network that took generations to enter. This social collateral is stronger than any legal framework. Banks are now trying to formalize gold loans, but they're discovering that their documentation requirements destroy the very flexibility that makes gold useful as collateral in the first place. Mumbai's banks range from HDFC's glass towers to cooperative banks that still use paper ledgers. Both serve purposes. The cooperative bank knows that the local grocery store's cash flow spikes during festivals. HDFC's algorithm doesn't. So the small businessman maintains accounts at both, using each for what it does best. This isn't primitive. It's sophisticated risk management through institutional diversification. Foreign capital enters Mumbai, seeking returns but finds complexity. A Singapore fund wanting to buy into Indian markets discovers that the same company might have 16 different share classes, each with different voting rights, most owned by promoters through Byzantine holding structures that make actual control impossible to determine. The fund invests anyway, hoping that growth will overcome governance. Sometimes it does. The mutual fund industry manages middle-class savings with a peculiar Indian characteristic, the expectation of guaranteed returns from equity. Fund managers must deliver growth while protecting capital for investors who treat equity like fixed deposits with upside. This impossible mandate creates behaviors that would seem absurd elsewhere. Funds hold cash during bull markets. They buy stocks they don't believe in because investors expect them to. Yet somehow, over time, wealth does get created. Insurance companies in Mumbai price policies for risks they can't fully model. How do you calculate the probability of a building collapse when you don't know if it followed building codes? How do you price health insurance when the same procedure costs different amounts at different hospitals for reasons nobody can explain? You don't calculate, you negotiate. The premium becomes a negotiated settlement between fear and affordability. The city startup ecosystem operates in parallel universes. The same entrepreneur might pitch to Silicon Valley VCs in the morning and borrow from a local financier at 3% monthly interest in the evening. Both forms of capital serve purposes. The VC money builds the technology platform. The informal loan pays the rent. Neither lender knows about the other. The entrepreneur sees no contradiction. Real estate financing in Mumbai involves creativity that would terrify Western bankers. Projects get funded through combinations of bank loans, private lending, advanced sales, and sometimes just prayer. A builder might sell flats that won't exist for 5 years to buyers using loans from banks secured against those same unbuilt flats. Everyone knows the risk. Everyone participates anyway because the alternative not participating in real estate seems riskier. The commodity markets reveal Mumbai's connection to physical reality. The same city that trades complex derivatives also warehouses actual cotton, actual sugar. During delivery periods, trucks full of commodities navigate streets designed for horse carriages. The physical and financial must reconcile. Sometimes they don't, creating defaults that ripple through clearinghouses. But the market continues because stopping would be worse than occasional failure. Currency trading happens in dealing rooms, where traders arbitrage tiny differences between onshore and offshore rupee rates. But the real currency market exists in underground networks that move money across borders without moving it at all. The Hawala system, ancient and illegal, offers rates that beat any bank. It survives because it serves needs that legal channels can't speed anonymity, and the ability to move value without documentation. Wealth management for Mumbai's ultra-rich involves structures that span continents. The family business is in India, the holding company in Mauritius, the investments in Singapore, the children in London. Money moves through these structures in ways that tax authorities struggle to track. Yet it's not always about tax. Sometimes it's about keeping wealth away from family members, business partners, or political changes. The structures are defensive, built not for optimization, but for survival across generations. The municipal bond market should be larger. A city of Mumbai's size needs massive infrastructure investment, but the bonds must be priced for risks that include political interference, construction delays, and the possibility that the project might never complete. So the yields are high, the tenors are short, and everyone pretends that the ratings mean something while knowing they don't. Small investors in Mumbai trade with intensity that algorithms can't match. They buy stocks based on tips from friends, astrology, and occasionally actual research. They hold positions that institutional investors would consider insane, entire portfolios in a single stock, leverage positions in derivatives they don't understand. Yet collectively, they create market depth that absorbs volatility. Their irrationality is the market's stability. The banking system extends credit based on relationships that transcend financial metrics. A company with weak financials gets loans because the banker knows the promoter's father. A startup with no revenue gets funded because the founder went to the right school. This isn't corruption, it's information that doesn't fit in spreadsheets. The relationship is collateral that can't be seized but rarely defaults. Financial technology companies are digitizing Mumbai's money flows, but they're discovering that digital doesn't mean simple. A QR code payment at a street stall might route through 3 payment providers, 2 banks, and a reconciliation system that takes days to confirm what happened in seconds. The complexity hasn't decreased. It's just hidden behind user interfaces. As darkness falls over Marine Drive, the city's financial metabolism doesn't slow. Money continues moving through channels visible and invisible. In Dalal Street, algorithms prepare for tomorrow's opening. In Dharavi, informal lenders calculate interest on loans that funded today's survival. Both are part of the same system. Neither fully understands the other. The Mumbai financial system works not because it's been designed, but because it's been evolved. Each crisis added scar tissue that became structure. Each boom created connections that became permanent. What remains is neither efficient nor elegant, but it's functional in ways that planned systems rarely achieve. It's a system built on the assumption that perfection is less important than persistence. This is finance in Mumbai, not a cathedral of capitalism, but a bazaar of money, where wealth gets created through friction, not despite it, where complexity is not a bug, but the operating system itself. The city doesn't simplify finance. It complicates it until it works.